What are the tax consequences of high net worth divorce? A high net worth divorce can dramatically change your tax picture, making strategic planning essential. Illinois uses equitable distribution to divide marital property, and courts must consider tax consequences under 750 ILCS 5503d. Under Internal Revenue Code Section 1041, property transfers between spouses incident to divorce are generally tax-free, but the receiving spouse takes over the original tax basis. This carryover basis means that the spouse who receives an appreciated asset may later owe capital gains taxes on the appreciation when it is sold. A divorce lawyer can evaluate the after-tax value of assets so that settlement agreements reflect true economic impact rather than face value. Capital gains taxes are a major risk in high net worth divorces because stocks, real estate and business interests may have significant unrealized gains. Long-term gains are taxed at federal rates up to 20% plus Illinois income tax, and high earners may owe the net investment income tax. If your home has appreciated, selling it before the divorce can allow a joint exclusion of up to $500,000, while a post-divorce sale limits the exclusion to $250,000. A divorce attorney can advise whether to sell the family home jointly or negotiate an arrangement that preserves eligibility for the home sale exclusion. Retirement accounts can be divided tax-free through a qualified domestic relations order for employer plans or a direct trustee-to-trustee transfer for IRAs. Taking a cash distribution instead of a rollover triggers income tax and may result in a 10% early withdrawal penalty for younger recipients. Spousal maintenance is no longer tax-deductible by the payer or taxable to the recipient for agreements executed after December 31, 2018 under the Tax Cuts and Jobs Act. Illinois provides a formula for maintenance when combined gross income is below $500,000, but for higher incomes the court has discretion to set the amount and duration. Because maintenance must be paid from after-tax income, high-income spouses may negotiate lump-sum property transfers or creative asset splits to achieve tax efficiency. Your tax filing status depends on whether you are married on December 31. A divorce finalized during the year requires you to file as single or head of household. Losing access to married filing jointly brackets can increase federal taxes significantly, so the timing of your divorce may influence your filing strategy. Buying out a spouse's interest in a business is generally tax-free under Section 1041, but the after-tax value must account for embedded capital gains and depreciation recapture. Stock options, restricted stock units and deferred compensation earned during the marriage are considered marital property in Illinois, and their taxation depends on when they vest and how they are exercised. Only one parent can claim a child for federal tax credits and head of household status, and the custodial parent must sign a release if the non-custodial parent is to claim certain benefits. Tax refunds from joint returns are marital property, and outstanding tax liabilities should be allocated between spouses. An innocent spouse may seek IRS relief if the other spouse misreported income. High net worth individuals should review and update wills, trusts, beneficiary designations, powers of attorney and healthcare directives after divorce because post-divorce transfers may trigger gift tax. In summary, high net worth divorces involve tax-free property transfers, but capital gains taxes, retirement rules, maintenance changes, filing status, business valuations, child credits and estate planning can all impact your bottom line. Consulting a knowledgeable divorce attorney and tax professional can help you minimize these tax consequences during settlement negotiations. A qualified domestic relations order directs a retirement plan to transfer part of an employer-sponsored account to a non-participant spouse and permits a tax-free rollover. Caesar & Bender, LLP is a Chicago law firm that helps clients navigate the financial aspects of divorce with tax efficiency. Our law firm is located at 150 North Michigan Avenue, number 2130, Chicago, Illinois, 60601, United States, and you can reach us at 312-236-1500. An experienced divorce lawyer can help you understand how Illinois law and federal tax rules apply to your case.